Welcome to The Explainer. Okay, let's dive straight in because today we're putting a massive telecom infrastructure giant through the absolute ultimate stress test. As an investment analyst, I love running companies through what we call the Guru Gauntlet. And today, that company is American Tower Corporation, ticker symbol AMT. We're going to analyze this REIT using the battle-tested frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham. Then we'll cross-reference all of those findings with modern quantitative models, like the discounted cash flow and dividend discount models. So if you're wondering whether American Tower is a buy, hold, or sell at its Q1 2026 price, you're in the right place. Let's get to it.
Here's a quick look at our roadmap. We'll start with a baseline snapshot, run through our three billionaire guru lenses, Buffett, Lynch, and Graham, crunch the DCF and alternative models, and then wrap it all up with a final synthesized recommendation.
All right, part one. Let's get a quick snapshot of American Tower Corporation to establish our baseline. Currently, we're looking at a share price of $168.59. It's offering a really attractive dividend yield of 4.25%, and it's trading at a forward price to earnings, or PE multiple, of 26.3 times.
Now, to really understand this company, you have to grasp the sheer scale of it. American Tower is a real estate investment trust, or REIT, and it boasts roughly 150,000 global communication sites spanning 22 countries. I mean, this isn't just a domestic play. We are talking about a global infrastructure backbone. And they're riding some massive, long-term structural tailwinds. Think about the continuous rise in mobile data consumption, accelerating cloud adoption, and of course, the explosive expansion of AI-driven workloads. All of this points straight toward a sustained, massive need for exactly the kind of high-quality digital infrastructure that AMT provides.
But, every giant has an Achilles heel, right? For American Tower, it's severe revenue concentration. T-Mobile accounts for 18% of their revenue, AT&T brings in 17%, and Verizon is at 14%. That means a massive chunk of their top line is tied up in just three mega players. This kind of heavy tenant concentration exposes AMT to significant consolidation churn. Basically, if one of those big three changes their capital allocation strategy or starts decommissioning sites, which, by the way, we're already seeing with the wind down of Sprint and Dish leases, it directly hits AMT's organic growth.
So with that baseline, let's move into part two and look at this through the Warren Buffett lens, focusing on moats and owner earnings.
The crucial question here is how AMT stacks up against Buffett's legendary checklist. Economic moat? That's an easy pass. The barriers to entry for building global cellular towers are incredibly high, and AMT's scale is just unmatched. Earnings consistency? Another pass. Q1 net income actually surged 76.2% year over year to $879 million. Return on equity? Also a pass. If we take their Q1 net income attributable to common stockholders, which was $860 million, annualize it to about $3.44 billion, and divide by their $10.15 billion in total equity, we get a highly impressive annualized ROE of roughly 34.6%. But then we hit the debt. Buffett famously hates heavy debt loads, and AMT carries a massive $31.2 billion in long-term obligations. Now sure, this is somewhat normal for a highly leveraged REIT business model, but in a strict Buffett framework, that is a fail.
Now, Buffett also looks incredibly closely at what he calls owner earnings, basically the true cash a business actually generates for its owners. Because AMT is a REIT, looking at traditional net income is a bit misleading since it includes massive non-cash depreciation charges. So our best proxy here is adjusted funds from operations, or AFFO. In Q1, AFFO was $1,324 million. If we go ahead and annualize that, we're looking at approximate owner earnings of roughly $5.29 billion. I mean, that is a massive cash-generating machine. Honestly, Buffett might actually overlook the debt for cash flows this strong. But, and this is a big but, only if the price offers a wide enough margin of safety. All right, moving on to section 3. Let's switch gears and apply the Peter Lynch lens, focusing on company categories and the PEG ratio. First things first, we have to categorize American Tower. In Lynch's framework, AMT is pretty much a textbook stalwart. It's a massive, multi-billion-dollar enterprise offering steady, albeit single-digit, growth. Specifically, they're targeting about 4 to 5% organic tenant billings growth per year. On top of that, they're clearly committed to returning capital, having increased their dividend for 2 consecutive years. Now, Lynch really liked stalwarts for portfolio protection, but again, only if you can buy them at the right price. And honestly, here's where the Lynch analysis hits a solid brick wall.
To find the PEG ratio, we divide the forward PE by the growth rate. So, taking that 26.3x forward PE and dividing it by their target organic growth rate of 4.5%, we get a PEG ratio of 5.8. Peter Lynch was famously looking for a PEG ratio of 1.0 or lower to indicate a stock was fairly valued. A PEG of 5.8 is just way out of bounds. To put it bluntly, the pure valuation math here would likely lead Lynch to rate this stock as sell, or at the very least, he'd tell you to completely avoid it at these current levels.
Let's step into part 4. Time for the harshest test of all, the Benjamin Graham lens, where we look at strict intrinsic value.
Let's run right through Graham's defensive checklist. Adequate size? Pass easily. A $78.5 billion market cap is massive. Earnings stability and a consistent dividend record? Pass again. They are highly profitable and pay out over $7 a share annually. But then we hit the valuation multiples and it gets rough. Graham wanted a PE under 15. AMT is at 26.3. Graham wanted a price-to-book ratio under 1.5. Let's do the math. Divide their $10.15 billion total equity by 466.8 million diluted shares, and we get a book value per share of roughly $21.75. At a share price of $168, that is a price-to-book ratio of about 7.7 times. That's an absolute failure on the Graham checklist.
Now, let's take it a step further with his famous intrinsic value formula. This is the square root of 22.5 multiplied by earnings per share, multiplied by book value per share. So we take the Q1 basic EPS of $1.84 and annualize it to $7.36. We use our calculated book value of $21.75. So plug that in, the square root of 22.5 times 7.36 times 21.75.
And that math delivers a pretty brutal punchline. An intrinsic value of just $60.01. With the stock currently trading at $168.59, there is absolutely zero margin of safety here. If you are a strict, deep value Graham investor, American Tower is completely untouchable right now.
Okay, so the traditional value gurus are skeptical. Let's pivot to part 5 and look at modern alternative models, specifically the DCF and DDM valuations. To build our base case discounted cash flow model, we first need to establish baseline free cash flow. In Q1, free cash flow was $941 million. Annualizing that gives us $3.76 billion. Based on management's outlook and industry data from our sources, we're going to forecast a conservative 5-year growth rate of 4%. We then discount those future cash flows back to today using a 7% weighted average cost of capital and assume a perpetual terminal growth rate of 2%. When you run all those numbers, it yields an estimated fair value of right around $145 per share.
And honestly, this is exactly why doing a sensitivity analysis matters. If you just slightly tweak the required rate of return, the WACC, or the terminal growth rate, the value swings. Look at our most optimistic scenario. Even with a 6.5% WACC and a 2.5% terminal growth, the fair value only hits $172. With the stock trading near $169 today, the DCF basically confirms that American Tower is currently priced for perfection, trading right at or slightly above its intrinsic fair value.
But hey, context is everything in investing, right? According to one of our analyst sources, while American Tower might look expensive in isolation with that 29.1 times forward PE, you've got to look at its closest domestic pure-play rival, Crown Castle. Crown Castle is trading at a massive 44.2 times forward PE, and the broader real estate sector benchmark, that's at 33.3 times. So, relative to its direct peers, American Tower is actually trading at a pretty significant discount.
Let's throw one more alternative model into the mix, the Dividend Discount Model, or DDM. This values a stock based purely on the present value of its future dividend payments. AMT pays an annual dividend of $7.16 with a 1-year historical growth rate of 5.03%. If we apply an 8% required rate of return to those figures, the DDM generates a highly bullish fair value of $241. If you're an income-focused investor, this right here is why you might love AMT. Because they return so much capital to shareholders, operating with a 110% payout ratio, income models rate this stock so much higher than traditional asset or earnings models. All right, part 6. It is time to bring all of these distinct lenses together for our synthesis and final verdict. Let's recap the gauntlet. The qualitative moats are incredibly strong, definitely satisfying Buffett's business quality metrics. But to get a real margin of safety, Buffett would likely wait for a price closer to $140. The rigid quantitative formulas of Peter Lynch and Benjamin Graham, they flat out reject the stock.
To Graham, it's worth $60. Our DCF base case lands right at $145. Only the dividend discount model at $241 suggests the stock is currently undervalued at $168.
So, as an analyst, it comes down to weighing these strengths and risks. The strengths are absolutely undeniable: global scale, the sheer explosion of 5G and AI data needs, and it's trading at a discount to its peer Crown Castle. But we can't ignore the risks. They're facing very real near-term headwinds with tenant churn from Dish and Sprint. That 110% dividend payout ratio, that leaves limited retained earnings for reinvestment unless they take on more debt. And speaking of debt, that $31.2 billion load is a very heavy anchor, especially in a higher interest rate environment. Blending all of this together gives us our final expert conclusion. The verdict on American Tower at roughly $168 a share is a solid hold. Listen, it's a world-class business that operates in an oligopoly and it generates billions in cash, but it is fully priced. We'd recommend waiting for a broader market pullback into the $140 to $145 range. At that price point, you align perfectly with the intrinsic value of the discounted cash flow model, and you finally achieve that required margin of safety that a Warren Buffett-style investor demands.
I'm going to leave you with one final thought to chew on. The telecom infrastructure space is in a major transition. The legacy cellular network consolidation is definitely causing some pain right now with tenant churn. But will the accelerating demands of AI workloads and heavy data centers act as a slingshot, completely overcoming that churn and making American Tower a screaming buy in the coming years? Honestly, it's the multi-billion-dollar question. Keep a very close eye on those organic billing growth metrics in the next few quarters. Thanks so much for joining us for this explainer, and as always, keep learning.